BDC stocks are often overlooked by investors because of their tax implications, but they can be solid investments in a diversified portfolio. I'm Jonathan, and today we're going to explain exactly what a BDC is, and then look at 5 that all have a starting dividend yield of over 7%. Time is money, so let's get moving. What is a BDC? What does it do, and what do I mean by tax implications? BDC stands for Business Development Corporation, and they invest money in privately owned, small and medium-sized companies. Generally, the businesses are facing challenges and need help to grow or get back on track, and they may not be able to obtain financing through traditional means like bank loans or bond issuances. BDCs aim to generate income and capital gains when the companies they invest in are sold, much like venture capital or private equity funds. They're attractive choices because almost anyone can invest in them since they're public companies traded on major stock exchanges. Venture capital and private equity are only available to accredited investors with large net worths, making them much harder to invest in. Business development companies were created by Congress in 1980 to jumpstart America's sputtering economy by helping fledgling small businesses raise money to scale and create jobs. Today, there are 47 publicly traded BDCs with a combined market cap of more than $49 billion. Most detractors say that since BDCs are almost always taxed as ordinary income, that they're not worth the investment. I definitely understand, but respectfully disagree as long as you're doing one of two things. Either properly diversifying your investments and making sure that BDCs are only a small percentage, or holding those investments in your non-taxable retirement account. So let's jump right in with our first BDC on today's list, Hercules Capital Inc., ticker HTGC. Hercules is the leading and largest specialty finance company focused on providing senior secured venture growth loans to high-growth, innovative venture capital-backed companies in a broad variety of technology, life sciences, and sustainable and renewable technology industries. Hercules has a well-diversified portfolio, including many well-known companies from many different sectors, and has long been considered a strong company in the BDC investment area, performing very well historically against its peer group, providing returns of 24% in the last year and more than 10% per year over the last 7 years. When looking at dividends, HTGC pays a quarterly dividend with the last announced payment of 33 cents due mid-March, giving it a dividend yield of 8.67%. It's hovered in the 8 to 12% range for the last 5 years with the exception of the pandemic spike, and it's paid dividends for 16 consecutive years with a 5-year dividend growth rate of 4.56%. Last week, Hercules announced it would pay supplemental cash dividends of 60 cents per share in 2022, which would be paid from the company's undistributed taxable income. In addition to the regular quarterly dividend of 33 cents a share, that means that investors will see a supplemental dividend of 15 cents per share payable each quarter in 2022, pushing their yield temporarily over 10%. We're all aware that inflation rates are rising, which means that the current price environment is forcing the central banks to take countermeasures in order to bring inflation under control. The central bank will have no choice but to begin an aggressive rate hiking cycle in 2022, increasing the cost of debt investments. Hercules' interest rate sensitive asset portfolio is poised to benefit from changes in the economic level of interest rates, potentially significantly increasing net investment income. The ultimate impact on net investment income is determined by how far the central bank raises interest rates. However, with a significant amount of debt investments in the portfolio, 94% of the BDC's debt investments are floating rate loans. Hercules Capital is set to see portfolio income tailwinds this year. They've consistently increased investments, assets, and net investment income year over year when looking at the last 10 years. They're growing and growing quickly. Their share price currently sits at $17.91, just 3% off its 52-week high. So although I do like this BDC quite a bit, I would look to buy when it gets a little closer to $17 a share. Their dividends are taxed as ordinary income and not as qualified dividends, meaning they're taxed at your normal income tax rate, and this should be taken into account when considering this investment. Next on our list is Capital Southwest, ticker symbol CSWC. Capital Southwest was formed in 1961 and elected to be regulated as a BDC in 1988, and it's an internally managed, credit-focused BDC that's an active capital provider to middle-market companies across the capital structure. Prior to 2015, CSWC had a significant concentration in 2 industrial companies and did not pay a meaningful dividend. But since that time, they changed their investment portfolio drastically, increasing income-earning assets from 1% to 92% of their total portfolio. And 91% of their credit portfolio is made up of first lien, senior secured debt. This is important because although no debt is 100% safe, all senior debt has priority over subordinated debt, which is also known as junior debt. In the case of default, creditors holding subordinated debt wouldn't get paid at all until senior debt holders are paid in full. CSWC pays a quarterly dividend with the last announced payout of 48 cents coming at the end of March, giving it a forward dividend yield of 7.84%. Their yield's been steadily increasing, and they have a solid history of paying not only regular dividends, but also supplemental and special dividends, making them an attractive BDC to hold. They paid dividends for an impressive 36 consecutive years and have a 5-year dividend growth rate of 46.5%, thanks largely in part to their extensive changes in company structure since 2015. Now, I don't expect it to continue at this blazing pace, but I do expect to see considerable growth in the coming years, most likely settling in the 10 to 12% range. Just like Hercules, our previous BDC, Southwest Capital has hedged itself somewhat against inflation, with 96% of its credit exposure considered floating rate loans and subject to increases as a result of rate changes. The operating leverage trend for CSWC is very positive, showing increasing assets over each of the last 5 years and decreasing operating expenses as a percentage of those assets. Their share price is currently $24.49 and sits 14% off its 52-week high, even after a positive return of 15% over the last 12 months. For me, it's in a good buy range now, and even more so if any drop comes in the near term. Capital's dividends are taxed as ordinary dividends for U.S. investors, and for non-U.S. investors, just over 87% of the dividends are exempt from U.S. withholding taxes. Third on today's list is the BDC King, Ares Capital Corporation, ticker ARCC. ARCC is a market-leading BDC and one of the largest direct lenders in the entire United States. It's a business development firm that specializes in middle market lending, boasting a market cap of more than $10 billion. It's also one of the market's longest-serving BDCs with a 17-year track record of success. ARCC has the ability to commit up to $500 million in a single transaction, making it one of the most fluid players in the market, and has grown investments over 400% in the last 7 years. They have strong relationships with over 620 sponsors and around 3,000 companies, providing it with the ability to finance and grow their business with portfolio-leading companies with a strong track record of success. Ares pays a quarterly dividend with the last announced payout of 42 cents coming at the end of March, giving it a forward dividend yield of 7.72%. They also recently announced a special dividend of 12 cents split over 4 quarters in 2022. They paid dividends for 16 consecutive years, and although their 5-year dividend growth rate is less than 1%, they are one of the most consistent payers in the business, and analysts expect to see an increase of around 7% in this year's announcement. They have a highly diversified portfolio with 75% of their debt being senior secured loans and no investment larger than 1.5% of their portfolio, with the average position being around 0.3%. They're heavily focused on defensively positioned companies in less cyclical industries, showing that they're committed to protecting their business and their high dividend in a volatile market. They hold relatively small amounts of debt in the hotel and gaming, oil and gas, transportation, and entertainment sectors when compared with their peers. This translates to a relatively stable stock price, although last year has seen it increase at a clip of almost 20%. It currently trades at $21.83 and it's just 5% off its 52-week high of $23. It's one of the most solid BDCs available, and I would consider it a strong buy at anything under $21, but I also wouldn't be mad at anyone that invested even at its current price due to its positive long-term outlook and attractive dividend. Over 97% of ARCC's dividend payments are taxed as ordinary dividends and are subject to your normal income withholding rate. Next up, we have the Goldman Sachs BDC, ticker GSBD. This BDC is a specialty finance company focused on lending to middle market companies, primarily in the U.S., and is managed by Goldman Sachs Asset Management, one of the world's leading investment management teams. They have over 800 investment professionals managing more than $1 trillion in assets. They have $3.9 billion invested as of the end of 2021, with 35% of that in software and healthcare. As mentioned with some of the previous BDCs, over 99% of their loans are considered floating loans and are subject to adjustable rates, with 85% of their liens considered senior secured first liens. There are currently 121 companies listed in their portfolio with a weighted EBITDA of 6.4 and surpassed estimates on many levels, beating expected earnings and profits. It is important to note, though, although I don't see them cutting their dividend, and we can never know for sure, they did miss their net income investment target in Q4 and their total investment income. GSBD pays a quarterly dividend with the last announced payout of 45 cents coming at the end of April, giving it a forward dividend yield of 9.1%. They paid dividends for 6 consecutive years with a 1.61% 5-year dividend growth rate. I see significant future growth for this BDC, but it is one of the riskier on today's list. Goldman Sachs BDC is currently trading in a trailing 12-month PE of 6.23, over 40% below the sector average. Additionally, its current PE is down 14.5% from its 5-year historical average, making the current price a great value even in comparison to itself in the past, let alone its competitors. Further strengthening this robust evaluation is the company's price-to-cash flow ratio, sitting at 3.86 on a trailing 12-month basis in comparison to the sector average of 8.81, over twice theirs. A reasonable current price in regards to its balance sheet metrics makes Goldman Sachs BDC an attractive play, even strictly from a value perspective. There are some major potential risks faced by all BDC companies, including portfolio liquidity risk, considerable debt exposure, and interest rate spikes. Goldman Sachs BDC contains a portfolio of assets in mid-sized and somewhat distressed companies that are not publicly traded. GSBD is currently trading at $19.63 a share and is 5% off its 52-week high. While BDC valuations are down across the board, the market's resilience with the growth of mid-market direct lending amidst the global pandemic shows promise for the future. The company's assets haven't increased and have been evaluated slightly lower in the past year, but this also provides an opportunity for investors to enter a position at a time when the company may be undervalued. If we have anyone in the house that's not risk-averse, this could be a good play. GSBD dividends are considered almost entirely ordinary dividends and are taxed as such. For 2021, over 99% of the dividend paid was reported in this way. And last on our list today is NEWT Business Services Corp., ticker NEWT. NEWT and its portfolio companies are premier providers of business solutions that are designed to help organizations grow sales, reduce costs, and minimize risk. It's a little different than the other BDCs in today's video, as they provide a myriad of services ranging from lending solutions to electronic payment processing to IT solutions. NEWT has a market cap of over $600 million and has consistently outperformed both the S&P 500 and the Russell 2000 over the last 10 years. This includes the drop in share price that they saw in August of 2021 when they announced that they had plans to convert from a BDC back into a bank. This is something to keep an eye on, but it's presented a great opportunity for investors to buy in at an attractive price. NEWT pays a quarterly dividend with the last announced payout of 65 cents coming on March 31st, giving it a forward dividend yield just under 10%. They paid dividends for 6 consecutive years with a 10.29% 5-year dividend growth rate and have historically hovered between 10 to 15% yield, making its investors very happy. NEWT has paid attractive dividends over the past years, and this is likely to continue as the business traction continues. An investment in NEWT is a way to gain exposure to the huge private business sector in the U.S. and small and medium-sized businesses in particular. The company should also benefit from a rising interest rate environment as top-line revenues is driven primarily by net interest income. All of this is underpinned by an attractive capital structure. While the company does carry debt on its own balance sheet, it has the ability to call existing baby bond debt. This should allow NEWT to refinance at a low cost of capital to enhance shareholder returns and continue growing its dividend payment. NEWT's share price is currently at $27.09, which is 30% off its 52-week high, and has still provided 14% in capital gains over the last year to go with that impressive yield. The company fundamentals, again, have not changed, leaving a great place for potential investors right now. It hasn't taken the hit in 2022 that the broader market has, and it's up 4% today in a market that's down an average of 1% since this morning. Because of the business diversification of NEWT compared to most BDCs, it's also a little different when it comes to taxation. 70 to 75% of dividends paid by NEWT are typically taxed as ordinary income, with the remaining 25 to 30% taxed as qualified dividends, giving a little bit of a tax break to go with that stellar dividend. Thanks for hanging out with me today and taking a look as we dug into BDC stocks. If today's video helped you out in any way, pop that like button and subscribe to join the Cashflow Nation. I'd also love it if you dropped a comment below and let me know what BDC you like. Did it make today's video? Thanks and see you next time.